Understanding cap tables, what founders often get wrong. A cap table isn't just a spreadsheet, it's basically a strategic blueprint for your company. In this episode of Capital Compass, we'll break down what a cap table is, why it matters more than what most founders realize, and the critical mistakes you should avoid. Whether you are raising your first round or preparing to issue employee equity, knowing your cap table inside out is the most essential part. We'll delve into what actually goes into a cap table, the difference between the common versus the preferred shares, how dilution works when you raise funding, what happens when safe notes and convertible notes actually are converted. And finally, we'll end with ESOPs, vesting, and why founders often underestimate their impact. Welcome to Capital Compass, the series wherein we help the founders raise smarter and build stronger. Today, we are diving into one of the most overlooked but fundamentally important concepts for any founder who's raising capital, the cap table. If you're building a startup, especially if you're planning to bring on investors, co founders, or early employees, this is not something you leave to your lawyer or to figure out later. So let's start with what actually is a cap table. Cap table, short for capitalization table, is a spreadsheet that lists who owns how much of your company. In the early days, it's just you and maybe a co founder. Two rows. You each own 50% or 60-40 split, whatever the split that you have agreed to. But as soon as you bring on a team, raise money, or grant advisory shares, your cap table grows. So each line shows who the shareholder is, how many shares they own, and what percentage of the total company that represents. For example, if you have 1 million total shares and your co founder owns 200,000, then they own 20% of the company. Why it matters? The cap table matters because it's how you get paid. It's your slice of the pie. If you raise money, your slice shrinks, and that dilution is not bad, it is expected, but it needs to be managed. So let's understand a key concept out here that is of a fully diluted ownership. This means that your ownership, after accounting for all employee options, all safe notes, and the convertible notes, all future dilution expected from planned fundraising. Founders often forget this. They think that they own 50% of the company, but they haven't factored in the next round's dilution or the stock option pool that the investors will ask them to create. And this brings us to the common versus preferred shares. Founders and employees typically receive common shares, investors receive preferred shares. Preferred shares come with extra rights, for example, liquidation preferences, anti liquidation provisions, voting rights, or board seats. This matters when you sell the company. Investors might get their money back before you see anything. Let's talk about safe notes, convertible notes, and hidden dilution. Here's a mistake that most founders make. They raise on safes or convertible notes and don't reflect those on their cap table. But those convert into equity, and when they do, that's when the founders get hit with unexpected dilution. And therefore, what founders need to do is always build a pro forma cap table showing what ownership will look like after those safes or notes convert. This brings us to ESOPs and the vesting. Investors will almost always ask you to create an employee stock option pool, usually 10%, sometimes more. They ask you to set that aside before they invest, which means that it dilutes you, not them. And those shares will be issued with vesting schedules. Standard is 4 years with a 1 year cliff. Same for you as a founder. If you don't have a vesting schedule on your own shares, investors may insist that you implement one. And this brings us to the final thoughts. So, your cap table is more than just a legal formality. It tells the story of your company's ownership and it shapes your leverage, your payout in an exit, and your ability to raise capital. Keep it clean, keep it current, and make sure you understand every line.